Hello, class. This is Anthony Taormina, and I'm going to be working Chapter 3, Quiz Access, problem number 6. So let's go through this real quick. We've got a few different examples. These journal entries are going to be entries that take place at the end of the year, so they're kind of like individual um, case scenarios, if that makes sense. So let's start with A. Make sure I'm on there. A. So it says depreciation on the company's wind turbine equipment for the year is $5,600. So this isn't actually the value of the wind turbine, rather the depreciation expense. So it's gonna be the accumulated depreciation for equipment, and we're recording that expense and that value as of December 31st, or yeah. So what we're going to do here is go to the first drop down. It's going to be depreciation expense equipment for $5,600. Yep. And we're going to debit that account. And then for the second entry here is going to be accumulated depreciation, and that's going to be credited $5,600. Okay, we'll record that entry. The second entry says prepaid insurance account for the solar panels had 2,600 debit balance at December 31st before adjusting for the cost of any expired coverage. Analysis of prepaid insurance shows that $900 of unexpired insurance coverage remains at year end. So this is a little confusing, but what it's saying is the insurance account for solar panels had $2,600 debit balance at December 31st before the adjusting costs. So not to reread it, but basically it's telling us that we have $900 of this $2,600 that is unexpired, and it wants us to know, or we're going to make an entry or an account. Sorry, not an account. We're going to make an entry for the expired coverage, and the way that we're going to find out what that is by subtracting what's left. So on our calculator here, I've got $2,600 minus 900, and that brings us to $1,700. So that's the amount of expired. And the way that we record that, or adjust that, I should say, is as an insurance expense. $1,700 of expired, and then that is coming from the prepaid insurance from the initial. So that's going to be credited $1,700. Sorry, let's see. $1,700 to look like that. We'll record that entry. And so again, just real quick, on the second transaction, it's expired insurance, what has been used up, that we're recording there. For the third one, the company received $4,800 cash in advance for sustainability consulting work. As of December 31st, one-third of the sustainability consulting work had been performed. So this is a service that was paid in advance. Basically, work that's been paid for, and we're going to record that one-third has been accounted for. And the way that we do that is the initial value was $4,800, and we're going to subtract. I'm sorry, not subtract. We're going to divide that by 3 to give us $1,600. So that's one-third of $4,800 is $1,600, and that's the amount that's being accounted for here of the work that's been done. So the way that we're going to represent that is unearned revenue is going to be debited. because that's unearned revenue, and that's $1,600. And then we're going to credit service revenue for $1,600. Or sorry, services revenue. And remember, this is just accounting for 1/3 of this service that has taken place as of December 31st. We'll record that entry. On the fourth one, as of December 31st, $1,800 in wages expense for the organic produce workers has been incurred but not yet paid. So this is expense that's been built up but not yet paid. So wages that have built up that have not been paid for yet. So it's just going to be this value here as of December 31st that has built up. And the way that we're going to represent that is it's a wage expense, and that account will be debited for $1,800. And then we're going to adjust that by crediting wages payable. Okay, so it should look like that. And this is again just wages that have built up, incurred but not yet been paid. And so we're just representing that with this entry. Okay, for the last one, as of December 31st, the company has earned but not yet recorded $460 of interest revenue from investments in socially responsible bonds. The interest revenue is expected to be received on January 12th. So what it's saying is, as of December 31st, the company has earned but not yet recorded $460. So we're going to record that. It's not expected until January 12th, but this transaction and entry is going to represent what has been earned. And yeah, so the accounts that we're adjusting here is interest receivable for $460. This is the interest that's been earned. It says it right here. Sorry. Let me put it in there now. Interest receivable from interest revenue. And then we're going to credit. Oh, I'm sorry. So $460 in is going to be debited in interest receivable account. And then we're going to credit $460 to the interest revenue. Okay. All right, and that is the record of the interest earned for this transaction. That's not necessarily due until the 12th, but as of December 31st, here is the record of it. We'll record our entry. So the journal entry that we've made here right now looks like this, and I'll go ahead and check my work and see if I made any mistakes. All right, answer is complete and correct. Again, the book talks a lot about depreciation and the values. A lot of those things are implied for long term. This is a pretty simple question though, so a lot of these are just the record of the transaction, the brief transaction that they're explaining. So hopefully that makes a little bit more sense. I know some of this section can be confusing, but this problem is pretty straightforward. If you have any questions, please comment on the forum or the post, and I'd be glad to try and help you with what I know. Thank you so much.